Welcome to the Daily Update. This is being prepared Wednesday, May 11th, where we'll look at the action in the market today and then see how things look for Thursday, May 12th. And it was another negative day. We're not seeing any kind of a bounce, at least yet. The CPI came out, markets gyrated around. At first, the S&P futures came back and actually went positive, then they went negative, then we had a positive open, then we dropped negative. So there's a real negative sentiment right now. In fact, we're getting to the extreme negative sentiment, and I'll have a chart to show you of that. But actually, even with the decline on Wednesday, we saw a little bit of improvement in the technical picture, and I'll try to point that out as we go along. Before I get going into the video, first of all, I just want to make you aware that the slides each day that I use for this video can be either viewed in a gallery format, downloaded as a PDF, or you can do a right-click Save As if that is interesting to you. I'm also trying to come up with some different ways of displaying the charts that I look at, but I don't use in the video. I'm trying to keep the videos as short as possible because I know you're all busy, but I still want to make this information available to you. And I'm also working on ways to download that as a PDF. Another thing that I want to mention is right now it's my plan to disable the YouTube comments coming up on Friday, May 13th. Now, I was contacted by somebody yesterday who said they've commented and they've commented before, but they didn't hear back from me. If you fall into that category, if you've left a comment on the YouTube channel, I always respond to those, even if it's have a nice day. But I always respond back. So if you're listening to this and you left a comment and you think I'm ignoring what you say, that's not my intention. I look at those and take those very seriously. So I don't know if there's some kind of a problem going on or what. The best way to talk to me is through email, and you can email me at john@spxinvesting.com. One of the reasons I'm considering disabling the comments is I'm only getting garbage there. I'm not getting anything from you who are watching these videos. I'm getting just stuff that doesn't really seem to matter. And I thought, okay, this is not turning into a real forum where we can have discussions, so why even allow the garbage to come in? I've also looked at setting up a YouTube community, but I have to be over 500 subscribers to do that, and I'm not there yet. If disabling the comments is not desirable to you, please let me know, either through a comment on Facebook, send me an email, if you're in the Facebook private group, what have you. Just let me know. Another thing is I'm going to be adding another kind of intermittent video. I won't necessarily be doing these every day, but a number of you rely heavily on InterMarket Analysis, which I call IMA. I'm going to start adding that video. Now, I'm not going to post it as quickly as I do the daily video. My first concern each day is to prepare everything for the video, get it recorded, get it edited, and get it uploaded as soon as possible. This video, I might wait and post even later, because when you're using InterMarket Analysis, you're not necessarily under the time constraints that I'm trying to project in the daily video updates. So let's go back and look at the day and see what happened. Right at the open, we did have a gap higher, but it didn't even get to R1. We set the high pretty much right after the open. Selling then took prices down to the daily pivot, which acted as support. We bounced off of that a couple of times. As the day went on, selling took prices eventually below the daily pivot and then went negative. Prices fell to just below S1, which was at about 39.50. Actually, it was 39.49 something, and I rounded up. As we went into the close, late day buying failed, and that was followed by some more late day selling, and we closed just a little bit off of the low. We ended up being down 1.65%. Volume was above average, and what we're looking at now are the technicals. Yeah, they're negative, but we're getting extreme, we're oversold, and we're even seeing a few indicators start to turn up slightly. And I'll have charts to show you of that. Inflation was the big story. The CPI came out, and I'll discuss that. And then interest rates. We also have a lot of the geopolitical concerns, which have been the same. And then earnings as they come out. Some are positive, some are negative. What are some comments that we can make? The S&P was down, but the technicals are showing some improvement. Not based on price, not based on moving averages, but we have a few oscillators and a few things that we measure that are starting to turn up a little bit. Interest rates declined and stocks declined. So that was interesting. A lot of times what we've been seeing lately is if interest rates go up, stocks go down. If interest rates go down, sometimes we see stocks going up. Now, that might be a little bit telling in and of itself because we've seen a couple of days over the last week or so where interest rates have declined, but stocks still went down anyway. So stocks are really having trouble finding anything positive right now. We did get below 4,000 again, and oil is back up over 100. It's about 105, I believe. Fear is getting very extreme, and I'll have the fear and greed index to show you that. But the VIX didn't really spike. We had a 1.65% decline. Things were decidedly negative. We closed at the low, but the VIX didn't really shoot up anymore. Is that a sign that things might be improving? That a lot of fear has already been baked into things? The S&P, yes, it's well into correction territory. In fact, if we keep declining, we're not all that far from bear market territory. As far as the economic report, I'll talk about the CPI on the next slide. We had the Treasury budget come out, which showed a $308.2 billion surplus from a year ago. They don't look at this month over month. They look at it year over year. Then the budget deficit over the last 12 months has been 1.2 trillion versus a deficit of 1.73 trillion that we did see last month. So it actually lessened a little bit month over month as well as year over year. But it's still very, very high. The weekly mortgage application index that we look at increased 2% this week. And our trend, it is negative and getting stronger. The bias with the down day is negative, and the momentum over the last number of days continues to be negative as well. So looking at the CPI, it increased 0.3% month over month, and that was in April. They expected it to increase 0.2%, so that was a little bit stronger than expected. They were really hoping that this would pull back a bit. The core CPI, this is something where they take out food and energy because that's all over the place. But if you take out food and energy, what good is this? Really, but the way they do the mathematics, since those prices are more volatile, they figure that this gives us more of good insight as to what's actually happening. But as I've said before, it's like, yeah, I'm a big Seattle Mariners fan. If you take out all their losses, they've won every game. So it just depends on your perspective. But the core and the markets pay attention to this. It increased 0.6% month over month, and they expected it to be up 0.4%. So that was higher than expected. And the futures and the bond prices and interest rates gyrated all after this report came out. The total CPI was up 8.3% year over year, which was down from 8.5% year over year in March. That's pretty much the inflation rate right there. And so we did decline a little bit. And so now you have people wondering, okay, have we topped out now? Have we peaked as far as inflation? Are we going to start coming down after this? Okay, that's one side that could be taken as potentially positive. Then on the other side, it's like, but the Fed still has to keep raising interest rates. And what's that going to do to the economy? So that's seen as a little bit more negative. And then one thing that I like to show right after the CPI is I go to a website called shadowstats.com where they show how the CPI was calculated back in 1990 and in 1980. Those charts haven't been updated as of this recording. I will include that in tomorrow's video update. So let's go back and look at the day's session. First, we'll look at sentiment. We're getting pretty extreme. We're well below 25. We're down at 19 right now. we're starting to see what could be critical mass. Then over here is a look at the historical chart of how this has changed over a period of time. And yes, I'm trying to use a mouse here, but it's not the way you traditionally use a mouse. If I click, it goes to the next slide where I'm trying to put some kind of graphical things on here. Here's the VIX, where on the closing basis, the line actually came down. The VIX actually declined. And then here's the bar down below where we closed just in about the middle on a down day that closed on just about the lows. So, the VIX has been higher than this. So we're not necessarily at an extreme reading compared to what it's been lately, but we're still at quite a high level. Could we see that as something positive? The VIX of the VIX also is showing that the VIX is really slowing down. We were up slightly with the VIX of the VIX, but well off of the highs, and we pretty much matched the high from a couple of days ago looking at the closing bar, just using the line. The Ulcer Index, this is starting to drop, which also is suggesting that fear may be coming out of the market. And this has dropped for a few days now. That could potentially be positive. Here's a longer term look where we spiked up on this chart, but now we're starting to come down after having a pretty extreme reading. People are still hedging. The put-call ratio is still very high on a day-to-day basis. And then if we look at the moving average, it's also spiking and even higher than we were back in late April. So it's just showing that fear's getting extreme according to this measure, but if you look at the VIX, it's not moving as much as maybe you think it would. As far as our sectors, we were down, so discretionary just got hammered, another 5.5% almost. Tech was down over 4%, communication down over 1%. We had a few sectors that were up, materials, utilities bounced up, and energy, the ones that have typically been doing fairly well in 2022. Here is looking back to the all-time high, energy doing the best, utilities are up. Everything else on a sector basis, on a raw basis, is down. Discretionary down well over 30%, 30.25%. Communication down almost 27%. Tech down almost 24%. Real estate down almost 18%. Financials down over 17.5%. Industrials, it's just not a pretty picture right now. Technical alerts, a lot of them were negative. Let me pick out the S&P where we crossed below 4,000. Big surprise there. We set another 52-week low today. And the Dow set a 52-week low. Oil first got above 100, then eventually got up to 105. Intraday, we spiked up at the open, and it was really hard to tell. The futures were up, and then the report came down, and they crashed really quick. Then they bounced back. So it was kind of hard to tell what kind of an open we were going to have. But when we did open, we spiked up, and then we went a little bit higher, but could not even get up to R1. We bounced down to the daily pivot, bounced back up, could not get up to R1 again. Then we broke down below the daily pivot, went negative, went all the way down and even a little bit below S1. Tried to bounce up off of that later in the day. That wasn't happening. So then we saw some more selling going into the close, and we closed just about at the low. Long term, we have now dropped below the pivot on this daily chart, and this is just not looking very good. But volume was above average, even though it tapered off a bit from Tuesday's volume. Here's some longer term possible support levels. Are we hitting any of these yet? Here's a dashed line. We're slightly below that with this line. Here's another support level potential that we've broken through now. So this just gives us some ideas of where some different areas of support could be. We're down 17.96%, almost 18% from the all-time high. Technical overview, what's positive? Nothing's changed here. Energy is doing really well. Commodities continue to advance. Gold is still doing well. And it did bounce slightly off the 200-day moving average, which is what I pointed out in yesterday's video. Interest rates, even though they've been down the last couple of days, they're still up overall, especially on a relative basis to the rest of the market. And staples still continue to be doing fairly well. What's negative? And here's the whole list. And this list is not different than what I put out in yesterday's or the day before or the day before video. All these different indexes are negative. I do have a Bitcoin chart that I'll show later on because it looks like there's some real trouble developing with Bitcoin and a lot of the cryptocurrencies. As far as our trend, we are still going up with the ADX. The dark line is continuing to advance, even though we saw selling pressure slightly decrease. Could that be seen as somewhat positive? We're also seeing buying power decrease as well, and that's why the ADX continues to advance. So we are in a trend, and that trend is negative. The Arun is still showing that we are negative, with sellers being in full control. That's what happens when this red line gets pegged all the way to the top, and we're seeing buying power really decrease. So when you compare the two, the oscillator down below continues to decline and getting rather extreme compared to what we've seen over the last year or so. Breadth analysis. We did have negative breadth, but see how it tapered off a bit, both based on price and volume? Could that be somewhat positive? Yeah, it's negative overall and declining, both based on price and volume. But does it look like it's slowing down potentially? Then here we're looking at the new highs minus the new lows. This is just a daily chart. We are getting rather extreme. We bounced up a little bit. We could go lower than this, but at the same time, this is pretty extreme negative. Here's a 10-day average. This is really starting to go down. We could still go lower than this, but we've also bottomed when we've reached this level before as well. The advanced decline ratio continues to decline. That's negative overall. Here's where we're seeing a little bit more improvement. The new highs, new lows, we saw less new lows than we did on Tuesday. The 5-period simple moving average, it is trying to turn back up, but it's still very negative here. If you look at the 10-day moving average, we are still in a decline. It's picking up earlier in this week and in last week where we didn't have a real expansion of new lows. Then accumulation distribution, this is negative. We're below the moving average and both are declining. Short term, the McClellan oscillator, negative and getting extreme negative. The force index also declined and we're showing an extreme reading, but we made a higher low on a down day when we've been seeing pretty much negative price action lately. Could that be a little bit positive? The stochastic RSI just pegged negative. Williams percent R pegged negative. The rate of change really negative. Going back 5 periods, yeah, it's very extreme right now. Extreme negative with the 20 and the 50 period moving average and still declining looking at the 200 period moving average. Stochastics, they just can't seem to buy any kind of a break in the short term. They are extreme. Intermediate term, extreme negative, and long term, also extreme negative and still declining here. All of these are still declining. We need to see some real buying to come through to see an improvement. When we look at all of the U.S. stocks and we take a 5-period moving average of the highs and the lows, we're starting to get extreme negative again. Intermediate term, rate of change, extreme negative. Based on 10 periods, 20 periods, extreme negative. Standard deviation, we're starting to get far away from the standard price of the S&P. All of the momentum oscillators continue to be negative, but look at the slope, very extreme. MACD, extreme. KST, it's still heading down. TRIX, PMO, TSI, these are just different momentum oscillators. Some react a little more quickly to price, some take a little bit longer to turn. They're all negative, but some of them are getting rather extreme. The vortex, haven't shown this in a few days. It does show where selling is increasing, but buying turned up just a little bit based on this chart. But because the red line is on top, this is negative. Summation index declining based on price and volume. We're not seeing a turn up in the volume yet. Sometimes we see this a little bit ahead of a bounce, but that's not happening. Sean trend meter. This is one that's actually turning up even with a down day. STO, it's declining based on price and volume and not necessarily extreme. BPI, getting more extreme. It dropped below 30 yesterday. Well, it continued to fall today. Here's a longer term view of that same chart. PMO, which I showed a little bit in the momentum oscillator chart, we are declining and getting pretty extreme. We're also declining when you just base it on price as well as on volume. So things are still negative. But then you look at things like this, the percent of PMOs that are rising in the S&P, we're extreme negative. We're also extreme negative with the percent of buy signals, but we continue to decline with those PMOs that are above zero. The CCI based on 14 periods, it actually turned up just slightly, and also on the CCI based on 20 periods. The boom indicator, we're still really going down when we look at how far we are away from the 50-period moving average, and we're continuing to decline when we look at the 200-day moving average. RSI not getting extreme, but negative with the 14 period. We're starting to get extreme when we look at the 9-period RSI. Here's the TTM squeeze. It's just showing the continuation of the decline and things are negative, and we've actually dropped a bit below this VWAP moving average. And if you didn't watch yesterday's video, this is a newer moving average that I ran across, where instead of just going back a certain number of periods, you can anchor this to a particular price, a high or a low, and then have it run from there. It looked like this might be giving us some support yesterday. Well, we've now broken down below that. Then on a longer term basis, we can use this TTM squeeze as an oscillator. We are getting pretty extreme negative. Different charts. A new zero was drawn on the point and figure chart. We're still having a signal that was generated on May 9th of a double bottom breakdown. Sounds like a dance or something. But yeah, this is still looking more negative, and another zero was added. The Renko chart still continues to be negative. The 3-line break still looking quite negative. Our different trading systems, the Elder Impulse system, negative with the S&P, negative with the SPY. SAR system that we look at, the dots are above, so we continue to be negative there. And with the go, no-go system, we are the dark purple. So we're seeing purple rain here. Long term, we are below the 200-day simple moving average. Looking at the rate of change going back 250 periods, we're dropping below zero. And here's a longer term look at that same chart. Our longer term moving average study, we are really going negative with the 50 simple moving average, 150 extreme negative, and we're getting extreme negative with the 200 simple moving averages. Special K continues to decline. This is our more longer term trend measurement tool that we use. Looking at the NASDAQ 100, this also, we didn't see a real spike up in the Vixen. Even though the NASDAQ 100 really declined and closed at the low, we're not seeing a corresponding spike in the bar, and we just saw a little bit of a tick up based on a closing basis. Now, this is something I just wanted to talk about because some of you are interested in this. I am not a Bitcoin investor. I love the technology, but I think that the market has become so crazy with people that just don't know what they're doing, and they're starting to see an awful lot of pain right now because Bitcoin is really running into trouble. But we're seeing some big head and shoulders formations, and then we're seeing other head and shoulders formations inside. So there's big ones and small ones even inside. Well, a year ago, I put this red text on this chart and actually did a video. And I said if 32 is broken on a closing basis, it could get very ugly for those who are long. That was based on this over here, where 30.2, at least this, and this is a different chart than a lot of people use, but we had hit a double bottom here. And then when I did the video, we were coming right down about here, right about where I have this circle. That's when I did the video. Well, then we were able to bounce up out of that, create another left shoulder. We spiked up again, created a new high, which could be the head for a bigger head and shoulders, came back down, got down to 35.7, bounced back up. We created a right shoulder. Now we're really seeing things fall. We have fallen below 32. We actually closed on this chart at 31.3, and I'm looking over as I record this, and Bitcoin is in the mid 27s. It's like 27.5. I just wanted to bring that up, not because I'm a yay or a nay against Bitcoin, but look at these beautiful head and shoulders examples here. And I'm not a big chart formation person. I don't use the bear wedges and the bullish pennants and I watch things all the time, and I get my feel from that just by observing what's going on. Some of you, I know, use a lot of different patterns, and you may disagree with that, and that's just totally fine. This is something that's a pattern, and it tends to be a reliable pattern, but at the same time, it's just a pattern. And we thought something was being told before, only to have it bounce and go back up and set an even higher high. I don't know what's going to happen here. But if we continue to break down below 30, which is what we're doing right now, which is even making this chart a bit out of date, it could really show some problems. All right, broad market. Dollar was down slightly, but still doing very well at 103.87. Oil spiked back up to 105.71. Gold futures, and this is the futures contract. We did bounce up off of the 200-day moving average. Here's the gold ETF, where I pointed this out in yesterday's video. Can we bounce off of this? So far, we have. And here's a longer-term look at the gold ETF. Silver actually advanced a little bit after just getting hammered. I know, the joke. I love that. It's one of those weird things where it was up, but we closed at the low of the day. And here's a longer-term look at the silver ETF. Looking at bonds, we saw a bit of a bounce based on price. That's why interest rates went down, especially in the longer-term maturities. Here's another one that I was looking at this chart going, wait a minute here. This goes back all the way to 1980, and this is even a daily chart. Look at how we're coming up to the previous level that we were at before the COVID plunge. Now, interest rates may end up going higher than this, but don't you think that if we come up to this level, we might bump into that and go back down? We've been going down, and we're not even quite at that level. So there may be some overhead resistance that we're bumping into just looking at the 10-year yield. And if interest rates continue to fall and the stock market gets some positive news, that may help some kind of a bounce. Just a scenario that I'm playing around with right now. This shows where yields, longer-term yields, have actually declined with the 30, 10, and 5. The 2-year was up, and the 3-month was up slightly. And then we're still watching the Japanese yen, as it's been in a real decline, as well as the euro. And even though the dollar was down, it's still been in a pretty strong uptrend overall. We have one potential positive scenario, but it's not even ready to be one yet. This is the mass index, and this is a 2-part indicator. The first part is when we cross above 27, and that's why I'm showing this chart. We went above 27. The trigger for this won't come about until we drop down to this dotted red line, which is at 26.5. So I just wanted to show this. This is just something that we're keeping an eye on. None of the other scenarios that could be positive are really showing us anything right now. So what's our outlook then? The technicals are negative, but maybe showing a little bit of improvement. Not much, but a little bit. But sentiment is so far negative. So watch the VIX. If we're really going down, see if it's going up, because that's kind of strange. It's not what we've been seeing lately. The markets have broken below this trendless intermediate term range that we've been in for 2022, and it's getting kind of ugly. We're still battling between growth and value. Value continues to win. Yesterday it looked like growth won, but today growth lost and value won. Economic reports. We have the PPI coming out, and that's kind of the big one. The CPI is for us, for consumers. The PPI is for those that produce things. And so if that really goes up, That means that people that make things are having to pay more, and ultimately we will have to pay more for that as well. Then the geopolitical events, Russia, Ukraine, again, could be positive or negative, but ugly overall. I did read something that said that China might be getting ready to lessen some of their lockdowns. So that might help an already bad supply chain situation. Inflation and interest rates are still what the markets are really focused on, but we want to keep an eye on oil. Earnings reports are kind of a case-by-case basis. If somebody in the Fed says something, and then the longer-term scenario with Japan, which I won't really talk about now, but it is something that I'm keeping an eye on. So our scenarios, we are still negative because of rising interest rates and inflation fears. Earnings and Fed speak can really drive the markets lower if it's taken as negative. The technicals are negative, but we are oversold. What could make the market go up from here? We are oversold. Could we get a bounce? The positive scenarios, I just showed the mass index just to show you that it went above 27. That's not a legitimate scenario yet. The technicals, because we're so negative, we might get a bit of a bounce from that. If we continue to go up from here, the pivots and previous levels may provide either support or resistance. And then sideways, we're not sideways because the ADX is above 20 and it's getting stronger and it's showing us that we have a negative trend. So our conclusion is the S&P is negative. Short term, negative and oversold. Intermediate term, negative and oversold. With the oscillators and moving averages really just not doing very well these days. Long term, we are negative because we are below the 200-day simple moving average. So thank you. Have a wonderful Thursday, and I'll prepare the next video after Thursday's session.